Good morning and welcome everyone to the latest session in the Protect Association webinar series. I'm James Evans and I lead the Protect Association while also working across the financial services sector in consumer duty, customer experience and vulnerability strategy. Delighted to have nearly 300 people signed up for today's session, which promises to be one of the most insightful and thought-provoking that we've run so far. Today's session is titled From Buyer Beware to Duty of Care, the Birth of Insurance Regulation. We'll be exploring how we got where we are today, why regulation became necessary in the first place, and what lessons from the past might help shape where we go next. I'm joined by two fantastic guests. Firstly, Malcolm Paget, Director at Paginator and long-time advisor on regulatory law, particularly within general insurance and financial services. And David Allison, Head of Intermediary Consultancy South at Insurance Compliance Services, a LinkedIn legend and someone widely known across the market for bringing clarity, practicality and just the right amount of controversy to compliance conversations. Also, a big thank you to Voice for sponsoring today's session and their continued support of our 2025 webinar series. They help firms track customer outcomes through AI-powered call monitoring and quality assurance, supporting consumer duty requirements in a practical and scalable way. Looking ahead, we're delighted to have Lithabo Motsoaledi, their CTO and founder of Voice, one of the Forbes 30 Under 30 in Europe 2023, joining us for September's webinar. That's definitely not one to miss, and next month we'll focus more on customer experience in insurance. Finally, a quick message. We're meeting for drinks in London next Thursday as the Protect Association. If you'd like to come along, just drop me a message. And if you're not yet a member of Protect Association or haven't yet joined our LinkedIn group, we'd love to welcome you. So let me know what works best for you and we'll get you included. So we really want today's session to be conversational and we'll make sure that we leave time for questions at the end. So do pop them in the LinkedIn chat as we go. That said, based on the prep session I had with David and Malcolm earlier in the week, I might struggle to stop them once we get going. They are serious regulation geeks, and I say that with admiration and just a touch of concern. So, David, you're up first. Now and then, a different world. So, we established that you entered insurance in the same year that I was born earlier in the week, which was great to hear. You've been on the inside as a broker, underwriter, now supporting firms with compliance. Take us back to what it felt like in the 80s and 90s and what was driving behaviour back then.
Thanks, James. Well, as an underwriter in the mid-80s, firstly under the old fire insurance tariff regime, which actually limited competition between insurers. Anyone remember SOPA and CLORA? And I was encountering quite a rapidly hardening market then, and we were slapping 15% on renewals routinely, using policy lists printed out by someone's high-tech dot matrix printer on Kalamazoo paper in huge ring binders, and we were marking them up with a red biro and sending it off somewhere for someone to do something somewhere. I don't know what it was. It was all very modern and exciting, and not a screen to be seen anywhere. But there was a strong commission-led culture in those days, even though special commission deals with brokers weren't as universal as they are today. And then I became a broker myself in the 1990s, and really it was all about maximising income from placements, provided, of course, and I would say this, that the client had the right cover in place. And since then, the surge in acquisitions has fueled a maximisation of commission deals as part of the rationale for acquiring other brokers. Commission uplifts, as we called them, and I should know because I worked in broker acquisitions for a while. There was obvious sales targets being prioritised. Suitability of cover remained vital, but I mean, I have to say compromises were sometimes made, both by brokers and by clients. I think intermediaries were generally trusted, but I did see examples of standard letters saying that a broker had shopped around for the client at renewal, which in some cases was a blatant lie. So there were some integrity issues there, I'd say.
Sure. Thank you, David. Malcolm, from your legal and regulatory perspective, how did this dynamic influence customer perception at the time? Malcolm, you are on mute.
Better?
Better.
There are many who would wish that I remained on mute, but there we go. No, James, what I was saying was I don't think you can underestimate for a moment the impact, the sort of seismic change which the introduction of creditor insurance, or the evolution of creditor insurance in the late 1970s and early 80s made to the whole general insurance picture. Creditor insurance being, for the younger members of our audience, what became payment protection insurance, and we all know where that journey eventually ended. Before we ever got to that point, general insurance, frankly, was only ever required, and it was only ever taken by, you might roughly call, the middle class, people who had assets to protect, knew that they had assets to protect, knew that there was a risk to their house or their jewelry or whatever, and so they used to go out to find out where there was insurance and to purchase it. And they'd usually in those days go to a broker in the high street and take advice if necessary. And if they didn't take advice, they just accepted that they were purchasing under what was in those days across the market, whether you bought a car or anything, a culture that says, well, buyer beware. You know, there's plenty of advice available. You can go and get that advice if you want, but if you choose to do it on your own, then it's down to you if things go wrong. And that, as a young lawyer, was exactly the legal world which I entered into. Insurers, therefore, owed no duty of care really whatsoever to customers when they operated via massively complicated legal instruments which they'd used for 100 years. We call them insurance policies, 40, 50-page documents with all sorts of terms and conditions attached to them. And they just expected a broker to explain the relevant bits of that policy to relevant customers if customers went to a broker to arrange their insurance. And then in the late 1970s, suddenly becomes the availability of widespread consumer credit. And that is taken out by a new group of people who governments were keen to enfranchise and welcome. And of course, that group of people were less aware, generally less educated, certainly in the worlds of money and financial services, and they didn't have assets to protect. They had debt to protect. And that was an entirely new marketplace for insurers, because there was a genuine belief by insurers and people in the insurance industry that consumers of credit were really blissfully unaware of the risks that they were entering into when they borrowed sums of money, dependent upon them remaining in work or remaining fit and able to earn the money in order to make the repayments. and they were operating in a very, very uncertain economic environment of the late 70s, early 80s. And so insurers knew that that market was going to be one where the customers weren't going to go out and seek insurance, buy insurance. They were not going to be advised by brokers. They were going to meet their lender, and that was the only opportunity for an insurance to be arranged of the nature we've been talking about. So credit insurance, and it's very important for people to remember this, was regarded as a good product imposed by the insurance industry on unknowing and uneducated consumers who, for their own good, jolly well ought to be purchasing it at the time that they took out a loan. And the saying for that market, and I think the underlying principle of this webinar is the saying was, insurance is never purchased by that community, it is only ever sold to them. And that is utterly different to the insurance market, which had existed for 100 years or so, where customers came to the market in order to purchase a product. So who was going to sell the insurance if the customers weren't going to buy it? And the answer was the lenders, and they were only going to highlight a risk to their customers that their customers probably hadn't thought about during the arrangement of their loan, if they were incentivized to do that, because otherwise it was counterproductive for the lenders. So the cost of insurance was generally, they would say, for convenience, we might say buried within one single repayment for a few pence more a month. You can have your creditor insurance protection. And consumers, to the extent that they ever even gave it a thought, assumed that a regulated consumer credit lender, because they were regulated under the Consumer Credit Act by that point, was probably going to sort of offer them something that was decent and okay for their purposes. But the problem was that the lenders really didn't have any massive great interest on the impact of the insurance on their customers. Insurers were still offering the same complicated product, which they had been used to designing 40, 50-page insurance products with all of the terms and conditions. Consumer credit was even more complicated, so the policies became even more complicated. But now, and this is crucial for what we go on and talked about, to a massively more innocent and naive and unaware, disinterested customer base. And there was absolutely no regulation whatsoever to protect customers at that point. And therefore, we've got the dynamic for the regulatory intervention that was followed.
Yeah, absolutely. So we arrive, as you say, Malcolm, at the rise of regulation, let's say. So how and why did regulation follow?
Well, I mean, in baby steps is the quicker answer. The first people who became a bit concerned that things weren't possibly as they should be was the Association of British Insurers, the ABI. And they were concerned about reputational damage because they were the association paid for and subscribed by the major insurers in the market who were involved in life insurance and other significant high value products. And the idea that there was now a marketplace in general insurance being sold by consumer credit providers was regarded with some concern, because the ABI became aware pretty quickly that the major driver for the lenders being involved in the market was that they saw insurance as a major profit or additional profit stream and not offering a product for its own inherent protection value. So the ABI set about introducing some codes of practice. They were very alert to the issue, and indeed, if you read the 1989 Code of Practice, it's pretty like the Consumer Duty, really. I mean, they were aware of the issues very, very early on. But the problem is that those codes of practice only applied to insurers, because it was the Association of British Insurers. And the insurers by that point had little commercial power or control over the lenders, who in the financial services market were the bigger bears, and accordingly they had no great power to ensure that those codes of practice were actually being implemented at the point of sale. The added value from creditor insurance very quickly attracted other retailers. I mean, moving on 7 to 8 years, the mobile phone industry, for example, was an adopter. We have the furniture and, of course, the motor industry, where they then saw that there was an opportunity to offer insurance to add to the value of, increase their margin, and frankly reduce the price of the product which they were selling by wrapping in insurance premiums into a single price. And they were selling insurance to customers who had little interest or little understanding. So we have people with little focus or passion for insurance selling insurance to people who had little interest or passion for insurance. And that, James, was a recipe for trouble, to say the least. And some form of regulation was going to be needed over and above code of practice to join the two issues together. But it was jolly slow in arriving.
Yeah. And David, do you think firms understood what was happening, or do you think it was just business as usual for them?
Probably business as usual for most of them. Some of them may have cottoned on to what was happening, but I think the priority was still short-term gain, to be honest. Compliance with any sort of code was seen as a nuisance and not a necessity. I mean, we hear all about governance these days. I think governance severely lagged behind in innovations in sales models. And as a result, I think the need for regulation, frankly, became unavoidable.
Yeah. So, Malcolm, how and when did meaningful regulation arrive then?
Well, when the Labour government of 1977, that's the Tony Blair government, was elected, in its manifesto was a commitment to regulate the investment market in London. This was the market that Margaret Thatcher had created and challenged. And the view was that if London was to remain an effective centre for financial services, then some better regulation of the investment markets in London was required. And that was going to be delivered by a new Financial Services and Markets Act, which became the Financial Services and Markets Act of 2000, FSMA as we all know it today. And the question back in 1999 was raised, should general insurance be regulated by the Act? Because all the other financial services other than consumer credit, which was separately regulated, were going to be involved. And the answer, and I think for those younger members of our audience again, it might be staggering to them, but the answer was no. The government said, no, we see no reason whatsoever to regulate the general insurance market and the selling of general insurance, because it's short-term insurance. It's only a year or two. The premiums are not very considerable at all. And accordingly, compared to our big act that we're passing, this is not a happy or natural bedfellow to be regulated. The insurance, and therefore they said, no, the FSMA will proceed without general insurance. The insurance industry, and now we are talking about a wider framework than just the Association of British Insurers, were more worried because the reputational issues impacting on many of the general insurers who had life insurance arms, Aviva and all the big insurers were concerned that if we got a mucky reputation growing in general insurance, it would impact on their wider business issues. So they set about, along with the intermediaries who were selling general insurance, to establish a self-regulatory body for general insurance. And this was going to be known as the General Insurance Standards Council, GISC as it became called. And this was crucially to be a regulatory body that had regulatory interest for both insurers and the people who were selling and arranging insurance as well. But just as GISC was being launched on the market, the European Union stepped into the story. And it proposed an insurance mediation directive to apply to all member states. And of course, we were member states at the time. And that would regulate the sale of general insurance. And that had to be in place by the year 2005 in order to meet the EU demands. And the EU said that that general insurance regulation could either be directly imposed by government under an act of parliament, or it could be delegated to a body that government approved as being the regulator for general insurance. And the widespread thought was the government were going to say, happy days, we've just got this new General Insurance Standards Council, so we will now authorize them to become the regulator of general insurance. The government didn't take that decision. To nearly everybody's surprise at that time, it decided that it would include general insurance as a regulated investment. Weird concept, but how it was phrased, as part of the Financial Services and Markets Act. And that terminology, which is still weird 20 years later, is an indicator of how sort of uncomfortably general insurance fits within the Financial Services and Markets Act. And so what we had then, and I remember standing in front of the UK Motor Trade in about 2002, trying to explain to them that they were about to become regulated by the city regulator, the Financial Services and Markets Act, Financial Services Authority as it was then. And the shockwaves that went through the market were enormous. You know, we can't do that. We don't have this. You know, we're retailers. We flog stuff. That's what we do. We don't deal with regulated products. So we then have a regulator that is, by that stage, 4 years experienced in regulating stuff, suddenly becoming the regulator of a constituency where the comprehension of how they thought, what the ideas were, what the concepts were, and what the requirements were woolly to say the least, and probably deeply resented, to be honest. And so we had regulation arriving with massive conflict of interest between business models, which by that stage had had 15, 20 years to harden, based upon intermediary interest in the revenue that could be generated by involvement in the insurance market, and a new regulatory regime that was absolutely targeted on the fair treatment of customers at the point of sale.
Yeah, I agree with everything Malcolm's said on that. And in fact, I'd go back even further. Who remembers the Insurance Brokers Registration Act 1977? So 20 years prior to that. And that was designed to regulate brokers, including their registration, training of staff, adherence to professional standards. And back then, even the term insurance broker was only able to be used if a broker complied with that legislation. There was an Insurance Brokers Registration Council, and they had a Code of Conduct Approval Order, 1978. That was updated in 1994. And interestingly, and as Malcolm said, the GISC, a forerunner to today's Consumer Duty, that IBRC Code of Conduct talked about the same sort of things the FCA is all over these days: conducting business with utmost good faith and integrity, placing the interests of clients before everything else, and they even use the phrase best interests of the client, ICOB 2.5.-1R these days, providing insurance to suit a client's needs, not unduly limiting the number of insurers that a broker uses, but warning clients about the nature of non-admitted insurers if they use them, and the FCA are all over that at the moment. They talked about brokers having good systems and controls, competent and suitable staff, adequately supervised, how to deal with conflicts of interest, how to declare any income on top of permission, and also providing reasonable assistance on claims, which was expected to be a broker's role in those days. We didn't have FOS, we had a complaints process, which was making a complaint to the IBRC. Now, so a lot of that sounds familiar. So this was 1977. So I honestly ask, how far we really come in nearly half a century? The Insurance Brokers Registration Act was repealed in 2001, and the IBRC was dissolved. And then, as Malcolm said, we had a bit of self-regulation, which always works well, doesn't it? Self-regulation. That was the GISC, and that promoted fair practices amongst its members. And as Malcolm said, the GISC lasted just 4 years before the Insurance Mediation Directive came in. We now have the Insurance Distribution Directive, which replaced it. And that was the start of the mandatory regime we all find ourselves in now.
Yeah. So, I mean, there are, as the point you've alluded to being that there are some clear similarities with consumer duty and regulation that we see now. So, have we moved forward? I think it's a pertinent question. But do you think that the conflict is resolved? So, fast forwarding to today, do you think that the tension between commercial goals and customer need has really gone?
No, it's still there. I mean, it's more difficult to make as much money as the old days in terms of percentage profits. But actually, the FCA wants firms to be reasonably profitable, because if they're not, they'll exit and customer choice is compromised by that. I mean, there is more structure and oversight in brokers these days, but not always more understanding. The trouble is, the FCA handbook is so multifaceted and complex. Bits of it are applied or disapplied depending on which parts of the handbook you're in. And you have to be very nerdy to properly understand it, which is obviously where the likes of me come in. Obviously, I can't speak for Malcolm's level of nerdiness, but I'm definitely a nerd when it comes to that. But some firms really are looking to just cover their backsides without embedding purpose. And that's more of a tick box compliance culture, which the FCA absolutely hates. And that's one of the few things I actually agree with the regulator on. I think there's been some progress under the consumer duty, somewhat reluctantly in many cases, but culture change is slow. Some firms, I acknowledge, have really embraced it. Others, particularly smaller ones, think they were doing enough already. And of course, they put their clients as the first priority. Otherwise, they wouldn't have stayed with them for all this time.
Well, that's another subject, I think. Depends on how easy it is to leave an organisation, doesn't it, at times? Malcolm, do you think the market has matured enough to manage this without regulation?
Well, no, is the quick answer, and I'm not sure it ever will. I mean, partly because, when we talk of the market, I mean, just listening to David then and talking about the Insurance Brokers Registration Council, for example, there used to be insurance brokers. I mean, there still are insurance brokers, but I mean, the volume of business that is now funneled through people who are not professional insurance brokers is such that the nature and dynamic of a group of people who, rather like lawyers and accountants, sort of say, well, if that's the regulatory regime, then it may be tiresome, but I need to put the staff in place in order to deal with complying with it, is still being addressed to industries where the chief executive of the organization, often based overseas, is saying, I just want you to maximize profit. That is what we do. Customers are out there as an objective from which we will make money. And if they've got a small financial element offering insurance in association with that business, that's not in the culture of the organization. It's very difficult for anybody in the organization to shift that happening. So I think as long as you've got underlying business models which are based on incentives, we are never going to deal with that issue of insurances bought, only sold, because the answer is it's being sold, because if that business dynamic cannot be maintained, then the people who are arranging and marketing huge volumes of insurance in the UK eventually will say, well, if that's the case, we're going to have to find some other profit center in order to generate the returns we need. So it's a most uncomfortable sort of set of bedfellows in the markets. So what we have is regulation for all the FCA would love to be saying, and I'm sure David and I would agree with them wholeheartedly, we want to encourage good practice, good behavior, and the outcomes of your business. If you look after your customers, the customers will look after you. And all of those good sentiments are actually being made impractical by the fact that the regulator is actually having to police behavior because of the commercial imperatives and drivers that are operating under the surface of capitalism in the retail market are driving behaviors towards customers which are very much at odds with what the regulator and most of the insurance market would wish to be the case.
So I suppose that leads us to the question, Malcolm, what should have happened? So looking back, if you could redesign the regulatory journey, what would you change?
I would, going back to the GISC, which by the way was not itself a particularly perfect model, but that's history now. But I would have regulation designed specifically to meet the issues which exist within the general insurance market, rather than that being bolted, clouded, overwhelmed, and muddied by the much wider pressures of compliance with the Financial Services Markets Act. Most of the things that FSMA is worried about aren't problems in the general insurance market in terms of structure and all of the other issues of financial viability and any other issues that a city regulator is concerned about. On the other hand, the things that we all know go on day in, day out in the general insurance market have not really been specifically touched by the regulator, albeit it's had 20 years to do so. What I would myself also have done would be to have introduced the requirement for consumer understanding, demonstrable consumer understanding, and products which were capable of being understood by customers as a fundamental tenet of anybody remaining allowed to offer general insurance in the market. The idea of offering 40, 50-page policies to customers who are buying a car in a hurry in a dealership and are only interested in the car and not the insurance is ridiculous. I mean, there is no way the customer is going to understand the product. I think both the regulator and the industry should have been focusing for years on the education of customers about what it is that insurance does, that you pay your money and quite often don't get your money back because that's how the insurer makes their profit. But on the other hand, if something went horribly wrong, you have a product that does protect you against those interests. Obvious to you and me in the industry, but not to your average customer. So then we would start to get to a situation where insurance was more often bought rather than sold, because customers become educated as their middle class forebears, in my crude example, knew 30 years ago that it's not a bad idea just to spend a very little bit of money to protect a lot more money, which is what we're talking about. The final big change I would have made would be to persuade, as I try to this day to persuade my client base, that if you apply just a small portion of the costs which you are incurring by providing incentives to people to sell insurance on marketing insurance in a way and in a manner that actually makes the product attractive to your customers, because if you don't think that it's attractive to customers, why are you selling it in the first place? And slowly, I remember the advertisement some years ago for insurance where the ghosts of deceased parents were walking around the house, and the children are sort of saying, well, if only we'd known, we'd have taken insurance and life would be better. Those sorts of adverts changed millions of people's understanding of the potential risk related to life insurance. The general insurance industry, and I'm sorry if I'm going to offend people, has not bothered to go to the effort to try and say to the public at large, a mass advertising media, this product is fabulous, it is essential, and you should be seriously considering going out and buying it. If they did, then of course the need for incentives would reduce, and a lot of the issues that we've dealt with over the last 25 years would not have existed.
Just to say quickly, we've had 3 comments. Thank you, Christopher, and a question from Spencer and a question from Sarah in the chat. We'll get to those a little bit later. We'll get to those at the end. Thank you, Rodrigo. So, David, from the perspective of someone who lived the reality, what would you have changed?
Well, I agree 100% with Malcolm that an insurance-specific regulator would have been much better. We've been shoehorned into a regulatory regime designed for investments, as Malcolm said. So we've got the ridiculous situation of the FCA handbook talking about investments, but then referring to insurance as non-investment investments. And and parts of the good old handbook. Oh, by the way, there's a new one coming out next week. If you've seen my LinkedIn post about it, you'll be getting excited. But apparently nothing's changed. So part of this handbook, which applied to other financial sectors, appeared to apply to insurance as well. But some of them are disapplied to insurance if you read another part of the handbook, which is quite easily missed, leading to potential over-compliance. I've seen examples of that. This regulator has been around for 20 years now, for general insurance. But we're only now really seeing malpractice brought to light more regularly and enforcement action being taken more swiftly, with some notable exceptions like Swinton's. This should have been the case from the beginning, really. I think if it was, we wouldn't have had so many additional rules written, which the bad apples in our sector have continued to ignore anyway. No one seemed to be afraid of the regulator, despite the FSA's CEO at the time, Martin Wheatley, his famous quote, "We'll shoot first and ask questions later." Who remembers that? That turned out to be a rather hollow promise, and Wheatley also admitted later that he regretted saying it. So I think with an insurance-specific regulator, compliance could have been more easily promoted to a more strategic role in firms, and brokers, frankly, could have had clearer boundaries to operate in as well.
So a question to you both. So bringing things up to date, what should firms be doing in 2025 if they want to really align with the spirit of regulation?
Well, I mentioned tick box culture earlier. Building compliance into the culture, not just into the paperwork. It is not a tick box exercise, although you'd be forgiven for thinking it was if you've ever had a cover holder audit. And I think, as Malcolm also alluded to, customer understanding, monitoring that continuously, and that's a major focus for the FCA under the Consumer Duty. The level of knowledge amongst the general public is frankly appalling, even amongst the highly educated, and I've experienced that firsthand, and I can give you some shocking examples. As Malcolm said, simpler policy wordings would be a start, but hardly anyone reads them anyway. Do you read yours? Simpler policy wordings will also inevitably cost more. I mean, that's just, regulation has made everything cost more. Simpler policy wordings will be more expensive. I'm an underwriter, so that's my understanding. That's inevitable. And brokers have a vital role to play in consumer education, in my opinion anyway. And that's where I think they can really add value. And treating compliance as a way to improve, not to restrict. Compliance shouldn't be the tail that wags the dog, and nor should it be seen as the anti-business department, which I've often heard bandied about.
And Malcolm, your thoughts on it?
Well, my first thought would be for firms to embrace the fundamentals of the Consumer Duty. Now that sounds very, very sort of little patty comment, but I've just written to my clients recently saying, the problem is that the FCA is saying it wants to reduce the burden and the volume of the words that is written about regulation. Well, the Consumer Duty just has 4 simple little outcomes and 3 simple little cross-cutting rules for firms to focus on. That's 7 things for them to focus on. Then you get a massive set of about 165 pages of detailed rules, guidance and whatever, saying what firms should simply focus on. And the risk within most firms are the compliance teams are terrified about the 165 pages, and the focus of management is placed upon the meeting of those detailed obligations, rather than saying, let's just ask ourselves 7 fundamental questions from the point of view of our customers and an objective view of our business. Are we actually treating customers in the way in which customers would expect under the Consumer Duty? The second one is, and we could have a debate a little bit about this if we have time later, is I'm a great believer in the design of simple products, not just short insurance policies, although basically my view is if anybody complains about their insurance product, they go to the Financial Ombudsman Service. And the Financial Ombudsman Service, as part of its decision, would say, well, we know and don't expect the customer to have read page 47, clause 372 of your policy. So we're not going to talk about that. We're going to talk about what we would have reasonably expected this customer to have understood from the product. So to me, all the focus of a product should be on delivering that little bit of understanding sufficient that the customer would never need to go to the Financial Ombudsman, because they will understand that issue in the manner that the Financial Ombudsman would have expected at the point of sale. And if anything is beyond the page or two of ifs, buts, and this is what your product does and doesn't do, no one is going to be able to take that into their brain at the point of sale. That's why I talk about simpler products. From an underwriting point of view, and I'm not an underwriter, of course, if customers genuinely do understand the product better and better and better, in other words, it's black and white, I either can claim or I can't claim, then from an underwriting point of view, the sort of uncertainty and mess at claim stage hopefully is eliminated. And the final thing I would do is to persuade intermediaries, retailers, and anybody else who is acting now in the widened GI market as an intermediary, that the retailing of insurance should not be anything about the obtaining of an additional profit stream. If you are going to offer your customers insurance, you should be saying, if we offer our customers insurance, this will enhance our sale of our product because our customers will feel more comfortable and confident in purchasing the product in the first place. And that story should be a good story for customers to hear. But we are, sadly, James, quite a long way away, I think, from that aspiration.
Certainly does feel that way. So whistle stop tour through, and hopefully there's a few takeaways for people in there as well that they might be able to begin to think about in their own businesses. So moving over to a Q&A now. So opening up to questions, please do keep them coming in the chat. Spencer, we'll start with your first question, which I will read out. And if you can bring up Rodrigo, that'd be great. Given the alarming 48% rise in low literacy among vulnerable communities, how can insurance regulations be effectively restructured to enhance duty of care, ensuring clear communication and tailored support that genuinely protects these groups from exploitation and misunderstanding?
Well, that's what the FCA has tried to do already. I think the FCA would, they would say, well, this is our expectation of firms. They've written so much about vulnerable consumers. That there's guidance on how to treat them. They've issued good and bad practice web pages. So I would say that the FCA are putting the onus on. They've said to firms, this is what we want you to do. In general terms, you've got the 4 outcomes from the consumer duty. You have to take vulnerable consumers into account. They've even now introduced proposing to introduce a vulnerable customer marker in their complaints reports that you have to file every 6 months. So it's at the top of the FCA's radar. I would say that they wouldn't restructure any more regulations at the moment. I don't know.
Less about restructuring and more about enforcing that the current regulations are properly executed by firms and they can demonstrate that.
I mean, I would only add that I think the question alludes to a social issue rather than a financial services regulatory issue. If 48% of the marketplace for products and services in the UK are by people who are, quote, vulnerable to understanding what it is they're purchasing, which may well be the case, we have got astonishingly big social problem to solve, because technically speaking, financial services firms should be saying, well, probably we shouldn't be offering anything to these people because it appears that they don't have the capacity to understand what we're selling. I'm not being glib, I'm being a bit short in a complicated issue, but there's a limit to how much further the financial services regulatory regime, as David has said, can go to addressing the issue, short of the fact that it really, the FCA could spend more time educating, but how do you get to these people?
I think I'm surprised that it's only 48%.
Well, it does depend what you mean by vulnerable and uneducated, doesn't it? I mean, if it comes to my pension, I'm vulnerable and uneducated because I don't understand hardly a word of it. But you know, and I just hope for the best, really.
Well, at least your pension's a long way away yet, Malcolm.
Well, true.
Good stuff. So moving on to Sarah Mill's question, doesn't the need for more compliance staff impact the income for intermediaries?
Yes.
Yeah.
It does, and of course that does raise the issue that in my experience, firms deal with that issue in two ways. One, if senior management actually become engaged and interested in regulation, and David was talking about compliance junkies. You know, I've got a couple of CEOs of my clients who are real compliance junkies. I mean, they're on the phone sort of, you know, debating with me what the FCA is doing because they want their business to really understand what this regulation is about. And therefore, their compliance staff aren't huge, and they are, as it were, part of the senior management team. If you get a different type of business, which is a remote senior management that relies on compliance in order to keep them out of prison, as it were, then the compliance staff does grow and the cost increases significantly. That would be my take.
Yeah, I mean, the question is about the income. I say it certainly affect the expenditure for intermediaries. It shouldn't affect the income. It should oil the wheels so that you actually, you know, you can do more business and do it in a compliant manner. So I'd say, as I mentioned, I think earlier, the ultimate impact of regulation is higher prices for consumers. And therefore, I think income for intermediaries is always going to be on an upward trajectory if they're doing things properly. But yeah, expenditure, bit of an issue.
Yeah. Thank you both. Okay, so more of a comment from Spencer following up, I think, than a question. So I understand Malcolm and David's perspective, but too often insurance policies are developed without meaningful input from those most affected. I think that can be agreed upon, certainly in my experience, especially with vulnerability and from diverse racial, socioeconomic and disability backgrounds. To ensure truly effective duty of care, outdated regulators must be reformed in partnership with professionals and bring both technical and expertise and lived experience. Can't disagree with the sentiment there, but any comments from either of you?
Yeah, I've got a comment on that. Any FCA regulations that are brought out are subject to consultation. The FCA does not get enough response to its consultations. They are an opportunity for professionals and the members of the public, if they can be bothered, to actually shape that regulation. So, you know, the regulations that we've got now, they were all put in front of us. You know, what do you guys think? And if the FCA doesn't get any input or useful input, they just go ahead with what they think from their ivory tower. So that's why consultations are a vital part of the process. And I think a lot of firms are worried about responding to consultations because they think, oh no, I'm going to put my head above the parapet and I'm going to have the FCA all over me. And that is not the case at all. The FCA need to hear from you. So I would encourage you all. You've got until the 2nd of July to have an input on the current consultation on simplifying the insurance rules, which I think is a bit of a misnomer, but there we go. If you don't, you'll get what you're given. And that's why we are where we are today.
I'm just going to reframe Spencer's question because I think he might have asked one of two things. I wonder whether Spencer might be asking, are the insurance policies of the insurers developed without meaningful input from those types of communities that he's mentioned? So proposition development from we need to design a new product for this particular target market that we've identified. Again, that's not necessarily area of expertise I would expect you both to talk on. That's not working inside the insurers, but in my experience, those groups definitely are not represented when it comes to proposition development or changes to propositions. But again, happy to let's I'll answer that question as well for Spencer.
Yeah, I'm happy to answer that. So we have product governance regulations. Prod 4.2. If you're an insurer, product manufacturer, you have a responsibility to make sure that the product is designed for the specified target market. You have a responsibility to test it, and that by inference will mean you have to involve people who are actually part of that target market. How can you test something if you don't? So the regulations are there. I cannot criticize the FCA in that respect, because the regulations are there. Now, whether people actually go along with that or not, or pay lip service to it, that's not the FCA's fault, although they're going to have to enforce it, obviously. But as far as I'm concerned, they've put the groundwork in place, and they expect firms to actually do a proper job, and that doesn't apply to intermediaries. It applies to insurers as well.
I think my concern potentially there is quite often you can see a new product that someone within an organisation, they may be senior, thinks is a great idea, and then if they do research, then they will invariably find that the research backs up their idea, because they would like their idea to be the one that goes forward into the new product that they can become known for. That's my cynical view on it. Malcolm, over to you.
Well, I mean, I'm not sure that's necessarily cynical. I mean, it's correct, but I'm not sure it's necessarily cynically correct. I mean, if you are running a business and you're an insurer, you rely upon people sort of coming to your front door saying, I am a specialist in this particular market. We have done our investigation into this market. We understand the target market, which under PROD, is a necessary matter, and we would like you to underwrite, this risk. And the insurer is actually usually quite remote from that target market and remote from the sort of ways and means and the tricks and the trades, that go on out in that marketplace. So the process, I think, is undertaken by this gets complicated. We may have co-manufacturing going on here, where basically somebody who's a non-insurer brings an insurance proposition to an insurer. And the insurers are relying on the broker's understanding of the vulnerability of the market and all of those sorts of things, and the broker is expecting the insurer to understand the underwriting and the necessary words that are necessary to put that into place. And I do think that there is quite often a significant sort of gap that appears between those two processes. So I think it's, again, back to the business structures that surround the general insurance market, rather than you being particularly, I don't think people are being cynically neglectful. It sort of happens as an outcome.
Sure. Okay, unless there were any other questions or any other input, Malcolm or David, that you wanted to get across, we will call an end to today's session. A further 20 seconds to put any questions on the LinkedIn page if anyone wanted to. But before we wrap up, obviously thank you to Malcolm and David both for joining us. Your insight and experience has been absolutely fantastic, and thank you to everyone who dialed in as well. Just a reminder about the Protect Association website, where you can find this and all of our previous recordings. Thank you again to Voice for sponsoring us this session and supporting Protect through 2025. And if you're not yet a member of Protect and would like to chat about getting involved, then just drop me a message either by email or on LinkedIn. Thanks again, and we'll see you next time.
Bye.
Cheers, everyone.